The role of central banks in monetary policy. Every time you swipe your credit card, take out a loan, or watch inflation rise in the news, there's an invisible hand shaping the outcome. That hand belongs to the central bank, whether it's the Federal Reserve in the US, the European Central Bank, or others around the world. Central banks quietly control the heartbeat of our economies. They decide how much money flows through the system, how stable our currencies are, and even how secure your financial future feels. The truth is this: no matter where you live, the decisions of central banks impact your wallet every single day. And in today's video, we're going to uncover exactly how they do it, why it matters, and what it means for you. Hey everyone, welcome back to the channel. If you're new here, please like and subscribe to our channel for more interesting videos. And here we break down the world of money, investing, and financial systems so you can make smarter decisions with your wealth. Today's topic is both fascinating and crucial: the role of central banks and monetary policy. Central banks are some of the most powerful institutions in the world, yet most people barely understand what they do. So by the end of this video, you'll know what central banks actually are, how monetary policy works, the tools central banks use to influence inflation, interest rates, and growth, and most importantly, how these decisions affect your day-to-day life. What is a central bank? Let's start at the very beginning. A central bank is the primary financial institution responsible for managing a country's money supply and monetary policy. Examples include the Federal Reserve in the United States, the European Central Bank, ECB, for countries in the Eurozone, the Bank of England in the UK, the Bank of Japan, and many others worldwide. Unlike regular banks, which serve customers, central banks serve the entire economy. Their job is to create stability, preventing inflation from running out of control, while also making sure the economy doesn't collapse into recession. Why do central banks exist? Before central banks, economies were extremely unstable. Private banks could issue their own money, which led to chaos. Wars, financial panics, and depressions forced governments to realize that someone had to manage the system. That's why central banks were created to stabilize currencies, act as lenders of last resort, and make sure the financial system doesn't implode every time there's a crisis. Core goals of central banks. Central banks usually focus on three key goals, often called their mandates: price stability, keeping inflation low and stable; full employment, supporting a healthy job market; financial stability, making sure the banking system doesn't collapse. In the US, for example, the Federal Reserve operates under a dual mandate: price stability and maximum employment. What is monetary policy? Monetary policy is simply how central banks control the supply of money and the cost of borrowing money, which is interest rates. There are two main types: expansionary monetary policy, used to stimulate growth, often by lowering interest rates or increasing money supply; contractionary monetary policy, used to slow down inflation, usually by raising interest rates or reducing money supply. Think of monetary policy as a thermostat for the economy. Too hot, the central bank cools things down. Too cold, they heat it back up. Tools of monetary policy. Now let's break down the main tools central banks use. Interest rates. This is the most visible tool. Lowering interest rates makes borrowing cheaper, encouraging businesses and consumers to spend more. Raising rates does the opposite, slowing spending to control inflation. Open market operations. Central banks buy or sell government bonds to influence the money supply. Buying bonds pumps money into the economy. Selling them takes money out. Reserve requirements. This is how much money banks must keep in reserve. Lowering requirements means banks can lend more, increasing money supply. Raising them reduces lending. Quantitative easing, QE, used especially after the 2008 financial crisis and during the pandemic. This is when central banks buy large-scale assets to inject liquidity into the economy. Each of these tools may seem technical, but they're all designed to influence two things: how much money is available and how expensive it is to borrow. Real-world examples. To see how powerful central banks are, let's look at a couple of examples. 2008 financial crisis. The Federal Reserve slashed interest rates to nearly zero and launched quantitative easing to stabilize markets. Without those actions, the recession could have been far worse. COVID-19 pandemic. Central banks around the world pumped trillions of dollars into the economy to prevent total collapse. This kept markets alive, but also contributed to the inflation we've seen in recent years. Inflation in 2022 to 2023. To fight rising inflation, central banks like the Fed aggressively raised interest rates. This cooled housing markets slowed borrowing, and gradually brought inflation under control, but also risk pushing economies into recession. How monetary policy affects you. Now, here's the part that really matters. How does this affect your daily life? When central banks lower rates, your mortgage, car loan, or credit card interest may go down. That's more money in your pocket. When they raise rates, borrowing becomes more expensive. Your monthly payments go up, but inflation usually comes down. For savers, higher rates mean better returns on savings accounts and bonds. For investors, central bank moves can make stock and real estate markets boom or crash. In short, whether you're buying a home, saving for retirement, or running a business, central bank policy shapes your financial reality. Criticism of central banks. Of course, central banks aren't perfect, and they've been criticized for several reasons. Too much power, unelected officials making decisions that impact millions. Short-term fixes. Some argue central banks just print money to solve problems, creating long-term risks. Asset bubbles. By keeping rates low for too long, they can inflate bubbles in stocks, housing, or crypto. Inequality. Policies like quantitative easing often benefit the wealthy more than average workers. These criticisms remind us that while central banks are essential, they're not flawless. The future of monetary policy. As we look ahead to 2025 and beyond, central banks face new challenges. Managing inflation without crushing growth. Adapting to digital currencies and possibly central bank digital currencies, CBDCs. Responding to global crises like climate change or geopolitical conflicts that directly impact economies. The role of central banks is evolving, but their influence remains as powerful as ever. So let's recap. Central banks aren't just abstract institutions in the background. They're the architects of the financial system. Through monetary policy, they shape interest rates, inflation, employment, and even the opportunities available to you as an investor or consumer. The next time you hear that the Federal Reserve or another central bank is raising or cutting rates, don't tune it out. Pay attention because those decisions directly affect your wallet, your savings, and your future. If you found this breakdown helpful, hit that like button, subscribe for more finance insights, and share this with someone who needs to understand how money really works. Thanks for watching, and I'll see you in the next one.